trap works like this. High mortgage rates prevent people from buying homes, which reduces demand. But many homeowners are locked into low-rate mortgages and don't want to sell because they'd have to buy their next home at much higher rates. This creates artificial scarcity that keeps prices elevated despite weak demand. Eventually, this artificial support breaks down. Economic pressures force people to sell regardless of the interest rate environment. Job losses, divorces, relocations, and financial stress don't stop because of mortgage rates. When these forced sales increase, they flood the market with inventory, just as buyer demand is weakest. The result is a market correction that happens gradually, then suddenly. Prices remain elevated for months or even years, giving people false confidence, and then drop rapidly when the artificial supports give way. This is the most dangerous scenario because it catches people off guard. They see stable prices and assume the market is healthy, but underneath the foundation is crumbling. When the correction finally comes, it's swift and severe. Let's recap the 5 warning signs we've discussed today. First, the extreme affordability crisis that's pricing out the majority of potential home buyers. When working families can't afford homes, the market becomes unsustainable. Second, the inventory surge combined with stagnant demand. This creates a buildup of unsold homes that eventually forces price competition among sellers. Third, rising household debt and financial stress. Over-leveraged families become vulnerable to economic shocks and may be forced to sell their homes quickly. Fourth, broader economic indicators pointing toward recession. When the economy weakens, unemployment rises and consumer confidence falls, reducing demand for housing. And fifth, the interest rate trap that's creating artificial market conditions that could collapse suddenly when economic pressures force more people to sell.